maybe the US is a little bit too greedy. That's why, because of their greediness, that causes the financial crisis very often.
Yeah, because you just speculate on something that is not there, you know. And you just take money, and then people put money. At the end of the day, we don't see that. So that's why it is, like I was saying before, you study the peak. As it go up to a certain level, withdraw. Because if you don't withdraw, there will be problems. So usually it's for those who are greedy who will suffer. But if, like for example, you buy stock, then for a certain period of time, sell it, you know, and then wait for another rising company. But if you want to wait until, you know, to get the most or the best out of it, you will fail. Yeah. So usually in my country, people just, you know, buy treasury bills, yeah, or maybe put fixed deposits and get small interest from the savings. But we also have financial bureaus who deal purposely on exchange rates. Yeah, they speculate, but the government still regulates them. Yes, because every morning the government will give a mid rate and a ceiling price. You cannot sell above this price, and you cannot also sell floor price. You cannot also sell below this price. Yes, in order for them to control the US dollar and also other strong currencies like the pound, sterling, and the euro. Yeah, especially these three currencies. So it's the central bank. It depends on their supply of the money. If they need it, or they know that the country needs it, probably they will increase the price. But if they think that it is okay, they don't need foreign currency to purchase any other thing outside like rice, because usually African countries, they just import. They don't export. That's where we are suffering. Because if you just depend on importing, you don't make anything. So there is no surplus. So all that you make, you just purchase foreign currency and use it to buy other things from other countries. So at the end of the day, you'll see the foreign currency will have more power on your currency. So you have to devaluate your currency, and then it will depreciate. At the end of the day, you cannot buy anything. Yeah, so that's why we are suffering. Yeah, and also politics. Politicians also play in the money market. Like our ex-president. Now, you can just sit down a day and just give a decree that today the US dollar is going to be pegged at 30. The $1 US to $30 is our currency is dollars. So you see, so with that, even the people who have bought more than it before and we are ready to sell above the price, their buying price, they cannot do anything. So, and he will force the banks, the commercial bank, to sell the US dollars to him, because he's a dictator. After 1, 2, 3 months, he will now increase the price and he will sell it back to the banks. So he will make money. You know? So he was playing that trick. So usually foreign commercial banks are always afraid to hold the dollar with them. So once they get it, they sell. Once they get it, they sell. Once they get it, they sell. And usually, like I was working in the treasury operation, we don't hold a lot of foreign currency. Anytime we have a seller, we try to look for a buyer immediately. Yeah. Because if you keep it and then, like for 1 week or 2 weeks, anything can happen. And you are playing with shareholders' money. You can't be losing. You have to explain every time.
Maybe go get a book.
Okay. Yes. What are you doing? Where's Coco? There's Paul. And where are your new co-workers? So they don't work there anymore? not yet, but the class will finish 4, and then I will have Chinese class from 5 o'clock to from 6 o'clock to 8 o'clock. Then you will check the train time for me because I need to come home. When you check train time for me, I will come home and then. Okay, if you do that, will be very great. Okay. All right.
This is one of the books. So the first part, the materials of the first part is from the book Economics of Money, Banking, and Financial Market Bonds. Okay. The second part, materials from the exchange rate market is from global investments.
Yes.
And 阮德正. Only you two. I will check it again. Okay, so and the second topic we have just went through. Okay, it is related to the priority of the claim. Okay, we can specify the market into date market and equity market. Okay, now let's take a look at the second one. Okay, based upon the date of maturity, we can divide the market into money market and capital market. Okay, so money market deals with short-term debt instruments, whereas capital market deals with longer-term debt and equity instruments. However, equity instruments have no certain date of maturity. Okay, that's why we say you can purchase and sell the same stock on one day, okay, on the same day. Okay, so money market, it has a less than 1 year date of maturity. Okay, so as compared to long-term securities, actually the short-term securities, they are more widely traded because they are not that volatile. Their prices actually are much more stable. Okay, so that attracts more investors to invest in the short-term securities. So basically, the short-term securities, okay, they become relatively secure. Okay, and firms and banks invest additional funds that they expect to hold temporarily into the market to earn interest. Capital market. Okay. Capital market, for example, like stocks, they have no certain date of maturity. Okay. As for the bonds, okay, these bonds, they have a longer term, and usually their date of maturity is longer than 1 year. Okay. So these instruments are held, usually they are held by insurance companies and pension funds. Because these institutes are more certain about the future funds they will possibly earn. Okay, so the difference, okay, again, money market, okay, they are short-term securities and their date of maturity is less than 1 year and they are less volatile. Okay, so who own them? Okay, firms and banks. As compared to the money market, capital market, okay, for example, stocks and long-term securities. And long-term, when we say long-term, that's longer than 1 year. Okay, and usually insurance company and pension funds hold the capital market instruments. Okay, so investment banks underwrite securities in primary market. Brokers and dealers, they work in secondary market. Okay, so the third type of market, usually we would like to know if the instrument is primarily sold. Okay, if it is primarily sold, then it is in the primary market. If it is not primarily sold, then it is sold at the secondary market. Okay, and investment banks, they are in the primary market. In the secondary market, we have seen brokers and dealers. Okay, so the primary market is the financial market where financial instruments are issued. So it is called a new issue market. And corporations, national and government, and other public sector institutions can get financing through the sale of new stock or new bond issues through the primary market. Okay. In the secondary market, it is a financial market where previously issued financial instruments such as stocks, bonds, options, and futures are bought and sold. And the secondary market raises the liquidity of financial instruments, hence lowering the financing cost. Okay, so if we would like to compare and then contrast the difference between primary and secondary market, okay, so when an individual buys a security in the secondary market, the person who has sold the security receives money in exchange for the security, but the corporation acquires new funds only when its securities are first sold in the primary market. Okay. So why is the secondary market important? Because firms, they acquire new funds through the primary market, but secondary market, it is important.
To determine the value of the firm,
Uh-huh.
the current value of the firm.
And what else? Can it increase the liquidity of the security, the secondary market? So how does it do that? So Charlie says it can determine the price, and Patrick says it can increase the liquidity.
Sell the stock that they already own.
Oh, so through sales and purchase, we can determine the price of the security. And also, the more often the stock or bonds is sold or purchased, the higher the liquidity it is. Okay, so secondary market make the financial instruments more liquid, and also it determines the price of the security that the issuing firm sells in the primary market. So please remark this because it is often tested in the midterm exam. Okay, so please underline. Okay, that's the important point. Okay, so why is the secondary market important? It is often tested during the midterm exam. Okay, because it makes the financial instruments more liquid. Also, it determines the price of the security. Okay, let's see the first reason why it makes the financial instrument more liquid. Okay, it makes it easier and quicker to sell the